Well, I know it feels like the stock market is on the verge of crashing or has already began that process, but we're not there yet. There are glimmers of hope taking place in these markets amongst the many warning signs, which we'll be going over on today's Stock Market Brief show and giving you an inside look of what it is that I'm specifically looking for. We'll go from larger time frames down to the smaller time frames to get you on the right side of the trend on today's Stock Market Brief show. If you haven't done so already, it's greatly appreciated if you just take 4 seconds to sponsor this show by hitting that thumbs up and subscribing to the channel if you like this type of content. Let's get into it. All right, ladies and gentlemen, welcome back to the show. We got a lot to talk about on today's Stock Market Brief. We got a big deck up ahead, that DECK. We're going to start off looking at the market today. Everything was up in the green, right? Up in the green. As far as the 11 sectors go that make up the S&P 500, small caps was actually down on the trading session when we look at the index products over there. Tech led the way. Woo! Yay! Tech is back, baby. Well, let's not get too excited yet. Some people might be saying, well, why did it go up today? Well, because it sold off super hard, right? From this high down to this low, we bounced and then we faded and now we're having inside trading day. So there's a lot of work to be done, but I want you to pay attention to this little pink line over here that's still tracking up. That's the 200-day moving average. We'll get back to that in a little bit. Let's take a look here at year-to-date performance on 13 various sectors. 11 that make up the S&P 500, but I included semiconductors because that's a heavy growth sector and it's performing incredibly well. And then I also included XBI, which is biotech. Yeah, biotech. Oh, what? Eep, up, oop. Here we go. Up, oop, up, eep, eep, oop, oop, oop. Here we go. Okay, there we go. If we take a look here, year-to-date, semiconductors is leading the way. That's up 25% year-to-date. Holy moly. And what's the next sector right below that? That's utilities, then financials, then consumer staples. We got communications and healthcare. And let me just be right honest with you. When utilities is one of the top-performing sectors, this is a more risk-off type sector. It's where typically traders go to, or investors go to, protect their wealth in turbulent economic times. And that goes with consumer staples down there too as well. Think of these as products that you want. Go take a look at a chart like Procter & Gamble or Coca-Cola. They've been just absolutely insane in recent trade. Now, I wanted to just call out more specifically, right, if we look at semiconductors and we look at the individual names, Nvidia makes up 20% of the SMH, 20%, maybe more, somewhere around there. But Nvidia is up 115% on a year-to-date basis. This is pretty wild stuff because if I pull up a chart of Nvidia, you can see that it's been kind of following this trend here, making a little, some might call this a head and shoulders. This I know was, we had a little bit of a negative divergence here as it was reaching up to these highs in an RSI that's not present. And we've been selling off recently back into and around this trend. I just want to call out that even if we were to fall from where we are, all the way down to around this level right around here, that would still mean that Nvidia is up over 50% on the year. It's a big, big, big move there for Nvidia. And we are seeing some types of topping patterns in the market. Like, for example, semiconductors. If I pull up the SMH, you can see we had a level of support here. At least that's what it looks like when you look back in hindsight. And when we came back into this level on this aggressive sell-off there at the beginning of August, we managed to bounce from this level again. And as we're coming back down, this is starting to look like a topping pattern known as one of the head and shoulders. Very obvious to see, and it's rather big. I mean, a break of this would take us down to like 120, which sounds ridiculous. But who knows? This market is ridiculous. But I also want to call out, just pay attention to that pink line. It's still there, inclining. Another one is Microsoft, and you can see Microsoft is also putting in somewhat of a topping pattern. But overall, that long-term trend, if we're looking at the 200-day moving average, it is still trending up. As price now is starting to get below it, the more we trade under it, you'll start to see it flatten out to potentially turn down, which is going to be important to note later in this video when we talk about stage analysis. And you can see the 50-day moving average over here, it has begun its descent. So it is currently trending down. So any bounce, if this is still trending down, even if we get above it, it should be treated with caution because you'd want to see this start to turn back up. It's a widely watched moving average as well as that 200-day. Google has seen quite the breakdown in recent trade, falling from 191 down to 148. I drew a line out here down to 140 because this year, if this level can be quite important if we come down there, and that's last year's closing price. And sometimes these year closing prices, or even the start of the year, which is down a little bit more, so this little zone in here, these levels can act as potential support. So I'd be looking for this level if Google wants to continue its descent. Now, it's not going to go straight down, right? It feels like that, like we saw this, but it's not without big bounces. And I just want you to notice that sometimes when we get these, nice big rally backs, they end up getting faded. As you can see, it's happened multiple times there with Google. Apple, by the way, it's holding up relatively well, but even Apple has somewhat of a topping pattern. This is known as Wyckoff distribution. Could be potential Wyckoff distribution, where you see these buying climaxes, the up thrust after distribution, you get some chop, and potentially it breaks back down through this 170 and starts heading lower. So this isn't to call out that, hey, these are head and shoulder patterns. That means the market's going to go down. Oh my God, it's bearish, bearish, bearish. No, it's not what I'm calling out, but I just want people to be aware that these can be potential situations that are going on, which will look obvious in hindsight if things do break down. For example, 6 months ago, we talked about little margin for error, where we hope for the best, but we prepared for the worst. And in that video, we were talking about the parabolic nature of various stocks that were going straight up, right? We pulled up this chart specifically and talked about the Parabola Curve step-like formation, how it builds out multiple bases to a point where it potentially blows off and starts moving in. Actually, some of those charts that we listed, here are the screenshots. We talked about Nvidia when it was reaching up to the skies, right? And this wasn't the highs, that we were still looking for a base for. SMCI built a base 4 and we got up to 1150. It came down and went a little bit higher, but we already know what happened to SMCI. That is trading way down here now at this particular point. And then semiconductors, this is at 235. This wasn't the high, but what did we just say about semiconductors? Well, semiconductors, right? When was this? This chart was in like February, March of this year. Okay, so February, March of this year. Where were we? January, February, March. Semiconductors right here. So we're talking about the parabolic curve, and then look at it built out one of those fourth bases, right? Go back over here. You get 1, 2, 3, 4, and then when we showed it, we had 1, we had 2, we had 1, 3, and then bam, we built out that other base. We went a little bit higher, and so far now this parabolic kind of curve that we've been seeing is starting to kind of implode on itself, creating somewhat of a topping pattern. Now, that doesn't mean it's over, but these are things that we called out in the past, so I'm bringing it to the forefront today, and now I'm showing you some more patterns that are topping patterns, but they're still within a very important aspect of this, and that is a positive trend, and I'll go more into that here in a short period. Now, another thing that we've been talking about for a very long time is the yield curve inversion uninverting. And this is the longest dating back to, so I've seen something like since 1929 or something like that. The longest it's been inverted, and one of the most deepest inversions that we've seen. Well, guess what? It's now at 3 basis points positive. So we've uninverted the 10-year, 2-year. The 10-year, 3-month, quote unquote, is the Fed staple. Right? The Fed staple. So that's the important one. That one has not uninverted yet. The 3-month tracks the federal funds rate to a T, basically. Okay, if I pulled up the Fed funds rate and that 3-month, now the Fed is planning on cutting rates here in September. At least the market's pricing in about a 75% probability. We'll see if that changes once we get some data here. Come Wednesday, we get some inflation data, I believe it is. Wednesday, and then Thursday is the PPI. If that changes, but we're looking at about a 25 basis point cut. So this little guy over here is going to go boop and move down slightly if that will be the case, which means that the 3-month will come down. It'll begin to uninvert there too as well. We'll see a steepening. And if we just look back through history when we had an inversion to a steepening yield curve and the Fed goes through a rate cut cycle, Yeah, I mean, it brought in volatility. It's not historically that great of a thing. Does that mean the same thing's going to happen? It doesn't mean the same thing's going to happen, but once again, we got to call this stuff out for what it is. It has happened multiple times. This is what historically happens. So if it happens again, are we going to be like, oh no, what happened? Right? No, it'll be a different narrative. There'll be a different catalyst because the time is different. It's always going to be different, but it doesn't mean that we can't still run into volatility. It doesn't mean that we're going to have a 50% decline. We could have a 70% decline, a 60% decline if it's something absolutely insane, right? But it could be a 20% decline, or it could go sideways for a very long period of time. We don't know, which brings me into stage analysis. Here we go. This guy right over here is Stan Weinstein. If you haven't read his book or listened to his audio, it's a good one. But he talks about I'm pretty sure he created the 4 stages, right, of market structure, where you go through stage 1, stage 2, stage 3, stage 4, where you have the accumulation, right? Then you have the markup phase, or maybe even Wyckoff. I think that was more accumulation distribution, but I don't know. And then you go through the stage 3 distribution, then the stage 4 of a decline. And the way that you can view this is by looking at that 30-week moving average. That's what he uses in his book. But I've heard at recent interviews, I mean, not really recent, that he changed to the 40-week, which is roughly the 200-day moving average. Well, where are we right now? And this brings me back to it. We'll look at the weekly time frame for the SPX. This right here, this line right there, that's the 40-week moving average, right? So the 200-day moving average, and then you have the 30-week right above that. They're both pointing straight up. The trend is still to the upside. Yes, the 10-week, which is about the 50-day moving average, is kind of flattening out, but it's, and pulling down a little bit. But these bigger moving averages are still trending up. So when I think back to the times like in 2007 or go to the dot-com bubble and you just pull up those charts, these, the averages were pressing up higher. And you didn't really start to see market volatility until price began to hold underneath these averages, where we kind of shot way down, came back up, and it held as resistance. We even overshot it, but it started calculating downwards, where the 30-week crossed beneath the 40-week, and then also the 10-week was declining as well. And through there, we saw, multiple, phases of this. We saw, 1 decline, 2 decline, or maybe I would just consider this 1, then boom, 2, and then boom, 3. Right? You typically get 3 waves. Large waves is pretty typical in like bear markets and crashes and stuff like that. If we go to the 2000, you can see here it's the same situation. We had the 30-week rising, the 40-week rising, and it wasn't until later over here where we started to get these averages really crossing through one another. And even then we back tested and they started pointing down. And this led us to say, hey, if you don't want to fight this trend, you might want to be careful here. And that's really what he's pointing out over here going into stage 4 of the decline. So something to be aware of. Now, understanding this, there's also micro cycles within this. And you can go here and look at a market cycle model where you have the longer term primary trend, could be 9 months to 2 years. That's the big green one. But within there, you have an intermediate trend, which could be the 50-day moving average. And even inside of that, look at this dotted line, you have smaller cycles going through, because this is how markets work. They're fractal in nature. To give you an idea of this, let's take a look at the daily time frame for the S&P 500, and we'll apply a 5-period, a 10-period, and a 20-period EMA. This is known as the 5, 10, 20 timer. It's an old school MA moving average tool. And what you'll notice here is when the 5 stacks above the 10, which stacks above the green, if they're all holding within this, realm, it keeps you in this trade for longer. And up until this area, which is probably roughly around this day, you had the blue below the red below the green, right? So that means it went 5, and the 10 was above that, and the 20 was above that. It means the trend has changed. So they all cross, and then look at the market goes through this, a little sell-off, stabilization, and then it all turns back up over here. And then it starts going back up. And in recent, going into August, or around August, right? Going into it, we had them all cross over before the yen carry trade kind of imploded. And then that said, even on the bounce back, it said, be careful, because the trend, it's still negative. You have the blue below the red, below the green. And then up until recently, which we actually had a follow-through day on this day, got us back in the trade to get us some more to the upside. And now what's it doing? Well, just take a look at the numbers. The 5 is at 54.89. The red is at 55.18. And then the green is at 55.20. So as it stands right now, you have the blue below the red, and the red, oh, there's a fly in my face, below the green. Okay, so right now, even if we bounce back up, you'd want to really see these things start to turn back up if you're looking and thinking about this in terms of the four stages of the four stages of market structure. We can get even tinier than this too, which is typically something that I do, but we can look at the 5-day moving average from an intraday time frame, right? So this is a 30-minute time frame on the SPYs, the Qs, the IWM, the semiconductors, XBI, and DIA. And as you can see here, when we see red, it means price is below the moving average and the calculation is still calculating to the downside. So on the smaller time frames, everything is basically saying, hey, be cautious here because the trend in the short term is down. It's not until this starts to get back above it, like for example, right over here, this is the DIA. The DIA is actually now above it, but the calculation is still going down. So it's giving us a yellow reading. Until this starts to flatten out and turn back up, once the calculation starts calculating up, and taking 5 days of data, calculating it up, it's going to start to turn green, and that would signal to us that we have a better chance to catch the trend to the upside. It's not a guarantee because markets can move quick, but at least it gives you the trend at your back to help you, because if you were fighting this trend in short, if you were fighting this trend to the upside and you kept on buying the dip, well, you can get destroyed. Right? But if you knew and you're good at short selling, maybe you shorted these, higher moves, and then maybe you caught a decent move there. I personally don't short too much, but I look for the long setups, and this I would be definitely paying attention to for these to start lighting up green as far as that glimmer of hope goes in the market. Another thing that we pay attention to specifically outside of the market cycles are these gamma flip lines. And the gamma flip line lets me know right out of the gate that market conditions are going to be in my favor for a swing trader or not in my favor. Why? Because above it and below it tells me what the market dealers, hedgers, whatever you want to call it, it tells me how they're going to respond to various movements. When we're below it, which we've been below it, you get much more volatile moves. You get selling into selling. You get buying into buying. This is where volatility increases, which is something that we've shared. This right here, you can see these gray boxes. This is the times that we've been since this just year of data or so. In the last year, when the gray box starts, that's where we're in negative gamma. And then we go back into positive gamma, negative gamma, back to positive gamma, right? And so forth. Even here on this big VIX spike, we were told like, hey, be careful here because this is where selling begets selling. And in a recent trade, we're still below that gamma flip line as it stands, and it happened on 9/3 at about 10 a.m. Pacific Standard Time. And we're still currently in that negative gamma where we can get selling into selling or buying into buying. So I'd be watching this 55.15. Right? It's going to update every day as we get more trade data. But as it stands right now in this current moment, once we start closing above 515, once we start getting back above a rising 5-day moving average, that right there will be my signal that, hey, I can start to get in, get a little bit more exposure into these markets, feel a little bit more confident on my swing trades, etc. If we take a look at the weekly time frame on the SPX, we are below the weekly 5 EMA as it stands right now. And typically when we get extended from it, right, to the downside or the upside, you get snapbacks. So for example, we sold off, we got very extended from the 5 EMA, boom, we snapped and overcorrected. We got extended again from it, and boom, we came right back down. And now we're kind of trying to find ourselves moving right back to it. But the direction of it right now is currently declining. You can even see that dating back over here where we got way above it, boom, snap back. We got way below it, boom, we snapped right back. Okay, let's take a look at the daily time frame for the SPY. The level that we've been watching for, the one that we've been talking about, we've been talking about the shakeout of 2024. This could still go, we don't know. But the shakeout, right, we're saying if it starts breaking down from this follow-through day, anchored volume weighted average price, start to look for a reconnect of the swing low. And we got through that on the prior trading session on Friday on that crazy volatility. Currently, we just have an inside trading day, but it did manage to recover it. So if you are long the stock market right now, there's a couple key levels that you might want to pay attention to, and that would be the low of today's trading session and or the prior day. Because if you think that, okay, this is going to actually hold now and we're going to start moving up, your risk, right, would be, say, right here, and where would the potential resistance be? Well, maybe it might be back up here at this anchor volume weighted average price. So your risk to your reward would look like this, which is a good trade. Now, if you start to say, okay, my risk is down to this low, now it's more like a 1-for-1. So it's more of a coin flip in these smaller bearish trends. So you can structure trades right now, despite it being in a bearish trend, but you got to just manage risk. That's my point. Now, if we take a look now going into tomorrow, there's a couple key levels, and I talked about this on my live stream this morning. If you didn't watch it, we talked about some individual stocks and kind of, it was a shorter stream. But right here is an important anchored volume weighted average price. This was last week's anchored volume weighted average price. Last week was the start of this month in September. So this is now the month to date anchored volume weighted average price. And as you can see, we came up to it. We were rejected. Round 2, fight. We were rejected. Round 3, didn't quite make it, pushed away from it. And now we're just floating in and around already the lower monthly expected move. We got outside of it. We came right back in. And you can see right here, this is going to be a critical level of confluence to take out. This is the month-to-date anchored volume weighted average price, and it's the declining 5-day moving average. From what I've seen in my past, sometimes when we can't get through it during the cash market session, but the market's bullish, it gaps up and through it. And that could be a bullish shine. It doesn't mean enter right away. It might mean, okay, look for the pullback and then follow through on strength. For example, we gapped up today. We started selling off. Okay. Oh, but then we ripped up higher and then we started pulling back and then we started to see a little bit of movement. So there's going to be times where you see these higher lows, and that is a positive sign. But the higher lows would be much more beneficial if we can get through the anchored VWAP. If the 5-day moving average starts to flatten out, something like this, maybe we, come up there, or maybe we gap up there the following day, come back in and we can hold it. And then we start to break out where we come test that prior follow through day anchor volume weighted average price and that upper weekly expected move. And that's when the trend potentially changes and we say, okay, now if we're going to really get going, this is the place where the market can really get moving. As far as the weekly expected move goes, we have 553.31 to the upside. So that'd be the upside target I'd be watching for the week, and 527.41. These are just levels of interest based off of implied volatility. It's not just me saying, yeah, I think the market's going to move like this. No, this is a mathematical calculation right here based off of the entire options train for the week ending it was taken on at the close of business Friday for the week ahead, okay? That's the data that I'm using to generate these levels. As far as tomorrow goes, we have 550.23 to the upside, 542 to the downside. And let me just be clear here, right? We've already tagged our lower quarterly expected move. That's way down here. That we did that in the beginning of August. But we are, once again, already, if we stay here for September, or move up a little bit higher, the market would be accurate in saying that this is our happy place for September. We saw that we can go this low, and we saw that we can go this high. I don't have the upper level in front of me, but we are right there at that lower level. Okay, it does not mean we can't break through it, but like I said, if you're worried about that, then obviously be patient for things to start showing signs of improvement. That's all I got for you on today's episode, everybody. Hope it helped out, gave you some insights, some things that I'm looking at. See you later.